Modern capital markets operate as vast ecosystems. Trillions of dollars move through a dense architecture of active investment vehicles, passive funds, and complex structured products. Operating parallel to this system is the rapidly expanding Islamic equities market, a sector that handles immense capital flows while adhering strictly to religious tenets. This entire alternative financial ecosystem relies on a single base layer. Every derivative structure, pool, and fund built within this space requires the existence of the individual Sharia-compliant stock. Investors can, of course, purchase these individual stocks directly on an exchange, but direct purchase is only the most basic method of market participation. To understand the actual depth of this market, we will examine the architecture built above that base layer. We will deconstruct how capital is actively pooled, how physical assets are securitized, and how passive indices are cloned. Analyzing this market reveals exactly how modern financial wrappers are engineered to execute complex trading strategies while maintaining absolute religious compliance at scale. The largest structural component built on top of individual equities is the Islamic mutual fund, frequently referred to as a unit trust. These funds operate through active management. Professional fund managers aggregate capital from thousands of individual and institutional investors into a single massive pool, which gives those managers immense purchasing power. The managers deploy this pooled capital across specific vetted asset classes. A typical fund targets a curated mix of Sharia-compliant stocks, Islamic fixed income securities known as sukuk, and compliant short-term money market instruments. Retail investors participate by purchasing units. Each unit represents a fractional slice of the entire diversified pool. Because the underlying assets fluctuate in value during trading hours, the price of these units must be calculated daily using a mechanism called net asset value, or NAV. This diagram shows the NAV calculation. We take the current market value of all assets held by the fund, subtract the fund's liabilities, and divide that remaining sum by the total number of outstanding shares. The way this price is quoted to the investor depends on the jurisdiction. In many markets, funds quote a dual bid and ask price. In markets like Malaysia, funds use a single pricing mechanism, where the quoted NAV already includes built-in operational charges. By utilizing this structure, retail investors gain two immediate mathematical benefits: instant portfolio diversification across multiple asset classes, and daily liquidity, even with a small initial capital outlay. These benefits require specific trade-offs. Investors must pay ongoing management fees, often including front and back-end loads, and they surrender all decision-making power regarding portfolio adjustments to the fund manager. The mutual fund is a strict compromise. The investor sacrifices granular control and accepts built-in fees to acquire active, Sharia-compliant professional management. Beyond paper assets, the market requires structures for physical property. This function is served by the Islamic Real Estate Investment Trust, or REIT. A REIT solves the problem of divisibility. It allows a multitude of investors to easily buy and sell fractional ownership in massive, illiquid physical properties, such as hospital complexes, office towers, and shopping malls. Islamic REITs operate predominantly as equity REITs. This means shareholder returns are generated directly from the physical rent and lease payments collected from tenants, rather than from interest-bearing mortgage instruments. To maintain religious compliance over physical operations, every Islamic REIT is bound by an active Sharia advisory committee. This committee's primary operational constraint is tenant vetting. They must audit the specific business activities of every current and prospective tenant leasing space within the property. This creates an immediate real-world dilemma for mixed-use commercial properties. Consider a large supermarket tenant that sells predominantly halal groceries, but also stocks a small section of non-halal goods. To solve this, regulators employ a strict mathematical threshold. Rental income derived from non-permissible activities cannot exceed 20% of the total rentals received from the property. This chart demonstrates the calculation methodology. Auditors divide the physical floor area occupied by the non-permissible goods by the total area of the store to determine the exact ratio of tainted rental income, ensuring it stays below the limit. Regulators also enforce a strict forward-looking constraint. Once a REIT is established, the advisory committee cannot accept any new tenants engaged in non-compliant activities, even if adding them would mathematically keep the total ratio below 20%. Malaysia has engineered multiple pioneering vehicles in this sector, listing the world's first Islamic healthcare REIT, Al-Akar KPJ, as well as the first Islamic plantation REITs. Islamic REITs demonstrate that Sharia compliance is not a static designation. It is a continuous auditing process that relies on rigid, quantitative ratios to sanitize returns from mixed real-world assets. If mutual funds are built for active management, another tier of the market is engineered specifically for passive observation. This tier starts with the Islamic Equity Index, a purely statistical barometer constructed entirely of vetted, compliant stocks to measure broad market performance. Based on these indices, institutions issue exchange-traded funds, or ETFs. Like this synchronized school, an ETF operates through passive mimicry, existing solely to track the exact performance of an underlying index. The ETF structure combines the broad asset diversification of a mutual fund with the frictionless, real-time trading mechanics of an individual corporate stock. Because an ETF's entire purpose is to blindly replicate a predefined list of stocks, the structure eliminates the need to hire an active stock-picking fund manager. Removing the active manager strips friction from the system, resulting in drastically lower operating costs and a minimal expense ratio for the investor. Furthermore, an ETF is not restricted to a single end-of-day NAV calculation. Because its shares are listed directly on an exchange, its price updates dynamically, and it can be traded constantly throughout open market hours. A prominent example of this architecture is the MyETF DJIM Titan 25, a vehicle that passively clones the exact movements of 25 Sharia-compliant Malaysian companies. ETFs offer investors a highly liquid, transparent alternative to retail mutual funds, proving that passive index cloning is viable within a compliant framework. At the extreme edge of the equities ecosystem exists a final unlisted tier, Islamic private equity funds. These vehicles are not accessible to the retail public. They are exclusive, entirely private pools of capital designed specifically to attract institutional investors and high-net-worth individuals. Free from the stringent regulatory reporting required of public ETFs and mutual funds, private equity mandates allow managers to utilize heavy leverage and deploy capital into highly complex structured products. Investors in these funds explicitly trade away the daily liquidity and transparent pricing of the public markets in exchange for the potential of aggressive, outsized returns. The immense capital requirements and risk profiles of these funds attract sovereign wealth funds and major global financial players looking to secure positions outside the public exchanges. Private equity funds occupy the most aggressive frontier of the Islamic equities market, demonstrating that the structural framework scales to accommodate high-risk institutional capital. By layering vehicles like mutual funds, REITs, ETFs, and private equity over a bedrock of compliant stocks, the market forms an interlocking ecosystem. Despite their different mechanics, every vehicle is bound by a strict underlying contract and continuous advisory oversight. With the complete architecture in place, investors can select their entry point based purely on their individual risk tolerance, desired liquidity, and investment horizon. This layered system ensures that Islamic capital markets maintain structural parity, diversification, and scale comparable to any conventional global market. Through meticulous engineering, through constant auditing, and rigid mathematical constraints, modern financial architecture successfully harmonizes immense global capital flows with strict foundational religious principles.